I'm sharing with you a simple way to remember the difference between capital and non-capital gains and losses. And for example, if we have a loss carry forward, would it be carried indefinitely, 20 years or 10 years only? When to prepare Form T1 or T2 or T3, and who receives the Form T4 or T5, for example. So all of these information can be confusing, but going through the sources of income from taxation point of view, it makes it so simple and easy to remember. So let's get started. So the different sources of income can come from employment income, business income, trusts, property income, other income, or capital gains or losses. When we refer to any source of income, we are referring to the net amount of income, which means the income earned minus any expenses or fees that were incurred in order to earn or gain this income. It is important to understand that individuals, corporations, partnerships, and trusts can earn more than one source of income. And the type of income that can be earned from employment, it's the type of income that you have to exert some effort, you do work in order to gain this income. As for business income coming from incorporated business, you have to operate the business in order to earn the income. The property income is the passive income, which means that you don't have to exert any effort in order to gain or earn this income. The other income is referred to as the income that resembles your salary. What I mean by that is that if you are receiving a certain amount of money every month or every period, let us say every month, because this is a good example to resemble your salary. So you take a certain amount of money every month, you receive it, but not from the other sources. It comes from either from a different source, like either the government as an assistance, for example, or the pension, or from an ex-spouse, or from insurance company, death benefit. These are some examples that you can receive income, and it's different from the other sources, and that's what we refer to as other income. As for capital gains and losses, this is the income when you sell an asset, and this asset used to bring you another source of income. What I mean by that, for example, if you sell a rental property or a franchise, that used to bring you property income, or stocks and bonds, or an equipment that you used to have operating your business, either incorporated or unincorporated business. If these types of assets were sold and you have some gains, that's what we refer to as your source of income from capital gains and losses. Another thing that we can remember that we are going to file the Form T1 for individuals if you have employment income or unincorporated business. T2 if you have incorporated business. T3, it concerns trusts. If you are an employee, your employer will provide you with the Form T4 at the end of the year, or a T4A if you are a subcontractor. If you have an investment, you might receive Form T5 at the end of the year. Another thing is good to remember is if we have losses, we can have losses, we refer to it as a capital loss, and we have losses that we refer to it as non-capital losses. And the non-capital losses, it comes from the operating a business, either the Incorporated or unincorporated business, like you have non-capital losses, this is the kind of losses that we refer to as non-capital losses. So it's good to remember this point as well. It is always good to remember that the individual tax return or the preparation of the T1 form is for the calendar year, which means from January 1st to December 31st, and it's on a cash basis, which means that what the individual received in cash during the year is what we are going to report only. So any money owed to the individual is not in our consideration or in our calculation. The money has to be received in cash, not only owed to the person. The individual can also operate a business which is unincorporated. For example, self-employed, sole proprietorship, partnership, or independent contractor or subcontractor. If the individual is a professional or has a professional service like a doctor, a dentist, an accountant, or so on. A salesperson that receives commissions, fishing and farming, all these sources of income or type of income are included in the individual T1 tax return form. An incorporated business is a separate entity business from the shareholders. It's the business that has a certificate of incorporation, articles of incorporation, and files T2 corporate income tax. The T2 is filed according to the fiscal year of the incorporated business, and it is the fiscal year end differs from one incorporated business to the other. Some incorporated business will choose and prefer to have the calendar year and the fiscal year corresponds together, and they are the same. Some of them, they prefer to have them differently. So it is different. The fiscal year will differ from one incorporated business to the other. The accrual basis system is the acceptable system for the incorporated business, which means that if we have sales by the end of the year, we send like invoices to the customers and they didn't pay us yet by the end of the fiscal year. Still, the sales revenue will be recorded on the business financial reports. It is acceptable. That means that we don't need to wait until we receive in cash the amount of money in order to record it. It can be recorded and still receivable, not received in cash. This is acceptable. Also, as we said before, that the losses that comes from any business will be called or considered non-capital losses and can be carried back 3 years or forward 20 years. Please remember and put in your mind that also the unincorporated business can also have the non-capital losses that can be carried backward 3 years and forward 20 years. The only difference will be when you request to carry backward the losses for the incorporated business, you will use a form that concerns the T2 forms. Or when you request to carry backward the losses for unincorporated business, you will use a different form, or you will request it on the T1 form. That's the only difference between them. But both are called non-capital losses and can be carried backward 3 years or forward 20 years. So the 4 examples of the property income would be if you own some shares and stocks, or you invest in loans and bonds in the public market, and you receive some interest income, for example, or dividends from the shares that you own in the public market, or rental income from your properties, or if you own a franchise and you receive franchise fees. These are the four examples of the property income: investment, dividend, rental, and royalty. As for the other income, you can be receiving the other income or paying and receiving other deductions. Examples of other income would be the RRSP CPP income, spousal support income, annuity income, and social assistance. On the other hand, if you are contributing to your RRSP, you will receive deductions. If you are the spouse that is paying the spousal support, you will also receive other deductions. So capital gains or losses occurs when we sell an asset and we receive the proceeds of disposition of an asset. And after deducting the cost that we incurred in order to sell this asset, which is called the adjusted cost base or ACB, we will have hopefully capital gains. And the good news that we are going to be taxed on 50% only of this capital gain, which we will call it the taxable capital gain, which is the 50% of the capital gain. But if we have losses, we will also consider 50% of the losses, and we call it allowable capital losses. So if we originally have a taxable capital gain, we can deduct the allowable capital losses from that taxable capital gain, and we will have the net capital gains or losses. So if we have a net capital loss, we can carry it backward 3 years or carry it forward indefinitely as capital loss. As I explained before, that anyone can have an investment of shares in a public company in the public market, and if they sell these shares, they can have capital gains. But what if you are an individual who owns 100% shares of a small private incorporated business, and you would like to sell this business as a whole? So if the business qualifies as the QSBC, which is the Qualified Small Business Corporation, and you sell the whole business and you have some capital gains or you have gains, then you can use the lifetime capital gain exemption. But if you sell the whole business and you have losses, then you can use the allowable business investment loss, which is the ABIL, ABIL, and this loss can be carried backward 3 years or forward 10 years. So as I explained before, if you are going to sell the whole company, you can either have a gain or a loss. So if you have a gain, you can use the exemption, which is called the lifetime capital gain exemption. But if you have a loss, you can use the allowable business investment loss, which is called ABIL. This loss can be carried backward 3 years or forward 10 years. The good news is that if this loss was not used completely within the 10 years, it can be converted to capital losses that will be carried forward indefinitely.